All right, today we're diving into a really fascinating story. We're looking at how a small company out of Texas has become, well, absolutely essential infrastructure for the biggest AI giants on the planet. The company is Applied Digital, and the big question we're asking is this the start of a massive growth story, or is the risk just way too high? Let's get into it. So you have to wonder, right? How did this even happen? It's really a classic story of being in the right place at the exact right time with a business model that is perfectly tuned to cash in on the biggest tech wave of our generation, artificial intelligence. Let's break down exactly how they're doing it. Okay, so to really understand Applied Digital, you need to stop thinking of them as a tech company. Instead, think of them as a very, very specialized landlord. What they do is build these custom super factories for the biggest names in AI, and then those giants sign some very, very long leases. At its core, the model is surprisingly simple. First, you've got the AI giants, and they need just a mind-boggling amount of computing power to train their models. Second, Applied Digital steps in and builds these massive, custom-designed data centers to house all that expensive hardware. And third, and this is key, the giants don't buy these places. Nope, they sign long-term leases. We're talking 15 years or even more. And that creates this incredibly predictable, long-term river of cash for Applied Digital. So, the big question is, how do they compete? Well, they have a secret weapon. Location, location, location. You see, all that computing power uses a ridiculous amount of electricity, and that is a massive, massive cost. By building their data centers in places like North Dakota, where power is just cheaper, Applied Digital can offer really competitive prices on their leases and still protect their own profit margins. It's a simple idea, but honestly, it's brilliant. Now, building on this landlord model, the company recently made a huge strategic move to make their story even cleaner for investors. They spun off their cloud services business into a totally separate company called Chronoscale. So why would they do that, and why does it matter? It was all about clarity. I mean, think about it. Before, Applied Digital was juggling two different businesses under one roof. You had the data center landlord business, and then this separate cloud services provider. It was kind of confusing for investors to figure out what they were buying. By spinning off the cloud business, the company now has this laser-sharp focus on what it does best, building and leasing massive data centers. It just creates a much simpler, cleaner story for Wall Street to understand and value properly. Okay, so now that the business model is simplified, let's get to the numbers, because this is where the story gets really, really exciting. Management has put a stake in the ground with a very ambitious target that has definitely gotten Wall Street's attention. And that target is to exceed $1 billion in annual operating income within the next 5 years. Now, what's interesting is that their original goal was just to hit $1 billion, but they've actually raised their own guidance. That signals a massive amount of confidence in their pipeline and their ability to grow. So, what exactly is this operating income, or NOI, that they're talking about? Well, it's pretty much the purest way to measure how profitable their data centers are. Just think of it like this. It's the rent they collect from their tenants, minus the direct costs of running the buildings themselves. It's the core profit engine, and it's the number that really tells you how well that landlord business is actually performing. Okay, so what's going to get them to that billion-dollar target? Well, the most immediate thing to watch for is a potential third major deal. Management has confirmed it. They're in negotiations with another huge hyperscaler customer. Landing that deal would be an enormous vote of confidence from the industry. And the potential size of this deal is just staggering. We're talking about something that could add anywhere from $5 to $10 billion to the company's contract backlog. You know, a single deal of this size could throw off hundreds of millions in annual operating income once it's up and running. That gets them a huge chunk of the way toward that billion-dollar goal. But you knew there had to be a but, right? With this kind of massive potential comes massive risk. And for Applied Digital, the entire investment story really hinges on them overcoming one single high-stakes obstacle. And it all goes back to their secret weapon, North Dakota. Here's the gamble. The company plans to deliver up to 600 megawatts of power to its campuses there. The problem? The local electrical grid was never, ever designed to handle that kind of intense, concentrated power demand. It's kind of like trying to push a river through a garden hose. It's a huge engineering challenge. And if there are delays in upgrading that grid, the consequences could be really severe. First off, revenue from these huge projects could get pushed back by 6, maybe even 12 months. Second, because Applied Digital has promised certain delivery dates, their big customers could use the delay as leverage to renegotiate for better terms or even shrink their commitment. And third, it could force the company to build somewhere else, in places with higher electricity costs, which would totally squeeze those profit margins we were just talking about. The potential impact here is very, very real. As one analyst put it, a significant delay isn't just a small hiccup. It could easily cause a 20 to 30% drop in the stock price. Why? Because it would create major uncertainty around the company's ability to actually hit those ambitious growth targets. So this brings us to the core dilemma for anyone looking at this company. It's a classic investment story. You have this massive, clear potential for incredible growth on one side and this single, critical point of failure on the other. It really is the definition of high risk versus high reward. So what does Wall Street think? Well, the professional analysts are incredibly bullish. I mean, look at this. Out of 12 analysts covering the stock, the consensus is a strong buy. That's a near perfect average score of 4.75 out of 5. They clearly believe the potential reward is worth that North Dakota risk. And you can see that belief baked right into their price targets. The high-end target is sitting at $99 a share. From recent levels, that suggests a potential upside of over 165%. Now, for that to happen, everything has to go right. The company has to execute perfectly, and that starts with getting that North Dakota power grid sorted out. So, we're left with the ultimate question. On the one hand, you have a simplified, focused business, a clear path to $1 billion in profit, and another massive deal cooking. But on the other hand, you have this critical infrastructure challenge that could derail the entire story. So, is Applied Digital's growth just getting started, or is the execution risk out there on the plains of North Dakota simply too high? That really is the billion-dollar question.